when you ended those bull surges, that last several quarters of the bull market, you went parabolic. Gold went up hundreds of dollars. Silver went from, like you said, 20 to 50 in a matter of, several months. The same was true in 79 to 80. It's also true in mid 2010 through April 2011 for silver. You went absolutely off the page. Right now, silver's, well below those price highs, $50. Fundamentals are even more dramatic now. Gosh, you can have $8,000 gold. Now, that's not a target. It's just noting past history is that silver's going to vastly outperform gold in the coming months.
In past bull markets, silver has experienced rapid parabolic gains, such as during 1979 and 1980 and 2010 and 2011, when it quickly jumped from $20 to $50. Although silver's current price is far below those highs, it has the potential to outperform gold significantly in the coming months, driven by similar market conditions that could trigger another strong upward move. Michael Oliver is a prominent financial analyst and market strategist. Explains during market downturns, gold often behaves differently from stocks. For instance, while the stock market continued declining into early 2009, gold had already returned to its highs by then. In the 1987 crash, gold rose 9% as stocks plummeted. Even during the Great Depression, 1929 to 1932, gold-related assets like Homestake Mining thrived despite the broader market collapse. Historical trends show that gold can decouple from stocks, often rising during stock market turmoil, although it's not a guaranteed rule. The stock market appears to be topping out, with some indices slightly above 2022 highs. If markets decline by about 5% in the coming months, particularly in September, key support levels could be breached, triggering a sharp downturn. While this may not lead to a crash, it could signal the start of a major decline. In response, central banks, including the Fed, might increase liquidity and cut rates, which would benefit gold. The market is vulnerable, and any wobbly performance could trigger momentum-based declines and potential Fed actions afterward. In early 2001, just months off market highs, the Fed cut rates twice in January, surprising the market. Despite rate cuts continuing for 2 years, stocks still collapsed. Notably, shorting the market when cuts began would have been profitable. Similarly, in 2007, the Fed cut rates just weeks before the market peaked in October. These examples show that rate cuts don't always prevent market downturns and can signal further declines. Let's jump into the video for more details. If you like what you see, please thumbs up and subscribe to our channel to stay updated with our latest content.
Stock market continued on down through the first quarter of 2009. Gold was back at its highs by early 2009. So they diverged. But there was that brief instance, and everybody remembers that, at least if you're around then. But if you go back through history and look at even crash events, like I happened to catch the crash in 87 before I set up MSA. I didn't catch it a big way, but I caught it to where it smacked me in the face with realization that, hey, we can measure some of these things, okay? At that point in time, gold went up 9% that was week or two of that crash. Why? I guess nobody told gold was supposed to go down, when the S&P crashed. But no, it went up anyway. And during the 29 to 32 great bear market, there was no gold futures or freely traded gold then. But Homestake Mining, the biggest gold miner in the world then, had a massive bull market during that huge bear market. Okay, so opposite the stock market. So the attempt to link gold to stocks as a fear element. Yeah, pay attention to it. Yes, if gold were excessively overbought at that point in time when the stock market decides to really have a puke, then maybe gold will participate to some extent to clean itself up some, or not. So don't think it is a rule carved in gold stone that it must follow the stock market. It certainly doesn't. Okay. Anyway, in the 2007 to 2009 bear trend, the stock market down the whole year and a half period, T-bonds and gold went up. From 2000 to 2002 bear market, gold went up, T-bonds went up. Okay. So here we are. I think we're topping out the stock market. Yes, we've taken out the 2022 price highs by about 10% or so in some indices. Some haven't even reached it. And if we roll over here, we think there's triggering factors in the S&P 500 and the NASDAQ 100 that will be engaged in the next quarter. If you merely ooze back down about 5% below where you're trading right now, those indices can't sneeze between now. So if September, for example, unfolds as a wobbly month, and we ooze back down several percent, you'll be in a position via our momentum metrics to trigger a structure, break a structure of support level that suggests you could open the Bombay door. Now, it doesn't have to be a crash, but it's likely to be a very sharp onset of major decline. And I think that the Federal Reserve and the monetary factors around the world will increase dramatically liquidity, artificially low rates. It's all the things they do, and that will benefit gold. So anyway, but we do see the stock market being in a very vulnerable position to where September better not be a wobbly, non-headline, but just wobbly a bit, pull back 3, 4, 5%, because you'll be in a position then to trigger certain momentum factors that say, gone, you'll go down. Anyway. So that's what we see in the stock market. And I think it's likely that those trigger levels will be engaged in the next month after September. Well, if you go back and look at 2001, in January of 2001, about 4 or 5 months off the high, not far off the price high back then. The Fed cut rates twice that month. Somewhat surprised the market, okay? They cut rates for the next 2 years. It didn't do a bit of good. Stock market collapsed. In fact, when they started cutting rates, if you circled where the S&P was, and went short then. It did great, okay? In 2007, 1 month before the high, in fact, about 3 weeks before the traded price high, which occurred in October 2007.
Michael tells over the last 50 years, gold has experienced a few major bull markets with significant gains. From the mid-1970s to 1980, gold rose from around $35 to $850, an over 20-fold increase. Similarly, from the early 2000s to 2011, gold surged from about $265 to $1,920, roughly an 8-fold gain. Starting from a low of around $1,050 in the current 9-year bull market, gold's gains have been modest in comparison. If past bull market metrics are applied, there's potential for much larger moves ahead. Gold is approaching key momentum trigger levels around $2,540 to $2,550. Breaking through these levels could lead to accelerated price gains rather than modest increases. Despite concerns, gold is not currently overbought. It has cooled off from its April highs after a sideways correction. Investor sentiment, especially among U.S. individual investors, remains low, with institutional investors driving recent gains. Major gold miners like Newmont and Agnico Eagle Mining have seen significant increases due to institutional buying, signaling a shift from higher-risk stocks to gold as a safer, high-reward alternative. China dominates photovoltaic cell production, supplying about 90% of the global market, with rising demand, especially in regions like Africa and Asia, where solar panels are crucial for off-grid communities. Silver, a key component in these cells, is seeing rapidly growing industrial demand, adding pressure on silver supplies. Unlike gold, silver's dual role as both a monetary and industrial metal could drive prices higher if supply constraints worsen. This unique demand dynamic could significantly boost silver's value as the market realizes potential shortages. Let's get back to the interview.
We can't put a price level on silver, frankly, or on gold, except to say that the bull market in gold over the last 50 years, the bull markets, there were a couple of them, were 8 and 10-fold moves. Go back to mid-1970s to 1980, went from the mid-$30 level to $850. Okay, or from 2000 lows about $265 gold, and you went to 1920 by 2011 over the next 10 years or so. Okay, that's an 8-fold move. Well, we started from a bare low at 1,050. You do the math. Yeah, we're double and a half. Okay, so no comparison in terms of how much multiple gain has gold had so far in this 9-year-old bull market. So if you use those old metrics, the recent high was 2450 gold, 2540 gold. You get up to 2540, 2550, and take out the high we made last month. It's not just because you take out that high, but we've got some momentum trigger levels. Whereas if you looked at a momentum chart, you wouldn't just see a high there, you'd see a ceiling, repeated bumps at a certain level. And when you go through that, it's like it's engaging a structure, is what we call it. And at that point, I think gold will no longer go up modestly versus its April high, but will go up in a more accelerated manner. A lot of people right now are saying, well, gold's overbought. Even gold bulls are saying that. Well, by our metrics, it's not overbought in the least. It's cooled off. You could say that back in April, when we moved up from we had a low this year at 1990 in February, 1992, I think it was. And you ran up to 2450 by April. That's a pretty dramatic surge. So you were overbought then, and you corrected that by cooling off, by going sideways. So we've had a correction that's cooled off all the momentum readings from overbought levels to more normal neutral type levels. So to think that gold is overbought right now, I don't quite know where they come up with that argument. Plus, even on a sentiment basis, we know that individual investors, particularly in the United States, are certainly not involved. There's no fever among investors, especially in the U.S., about gold. In fact, you look at some of the biggest gold miners out there, like Newmont and Agnico Eagle Mining, AEM. AEM's back to its all-time highs. 2020 high, the 2011 high, and so forth. And it did it rapidly. And if you look at the component of ownership, that's like one of the top blue chip gold miners. Newmont's the biggest one. And Newmont's gone up 60% since February. It's largely due to institutional investors, major portfolio managers who are saying, we need to make some shift out of the stock market, the normal stock market, where the risk is high and the rewards are probably now less, and go to something that has lower risk, higher reward, the gold mining sector. And they're not going to buy juniors. They're going to buy the big blue chips. Well, like AEM, I just discovered the other day, 76% of its ownership is institutional buyers, not individual investors. And I'm sure the same is true with Newmont. We know some big asset managers bought Newmont back in February when it was in the low 30s. Well, they're up 60% right now, 6 months. They're doing pretty well. But it's large institutional investors. The public is not foaming at the mouth about gold. So to argue now that gold is overbought, I don't quite understand, but it's a widespread notion. Plus, the sales around the world are going off the page. China produces 80-90% of the photovoltaic cells that are in the solar panels. And while the price of those has come down over the years and demand globally is increasing massively year by year, I'm not talking US necessarily, but Africa and Asia, you don't necessarily have embedded power lines under your community. You're out in the middle of nowhere and you need some solar panels so you can have your cell phone, which a lot of people have, in parts of the world that didn't used to have it. So demand for that. Well, silver is the central ingredient of that. It's a huge component now of silver industrial demand every month, every year, and it's increasing exponentially. And that's a factor that could suddenly pinch silver supplies. And that's a factor few are discussing. It's a monetary metal after all, but it does have that other attribute that gold doesn't have, which could cause it to go berserk at some point once the realization hits that we're going to run out of supply because we don't produce enough to meet up with that demand. So there's all kinds of factors there that indicate uncertainty, but it's also something that actually could help boost silver in and of itself.
Both gold and silver are positioned for potentially significant gains due to unique market dynamics and supply-demand pressures. As economic uncertainties and shifting investor sentiment drive renewed interest, both metals could see accelerated upward movements, making them standout assets in the coming months. How might rising demand for silver in the solar industry and its potential supply constraints impact its price relative to gold in the coming months? Share your thoughts in the comments below. We'd love to hear from you. If you found this video useful, don't forget to give it a thumbs up and subscribe for more content. Thanks for being a part of our journey.